So I'm going to start with, we can use really whatever ticker we want. But so you're familiar with, essentially the wheel where you start
Yeah.
essentially the top of the wheel with selling puts, and you collect a premium on that. So I guess from the very basic perspective, I'm going to look at a ticker that I want to, and the hub of this is, and when I say the hub, I mean, and I'm kind of playing off the idea of a wheel, but like the hub of your wheel should be a ticker that you want to own long term, right? That's going to be the core of your wheel portfolio. And I don't know if you have like different portfolios based on different trading styles or strategies. I do, and it helps me kind of focus and manage those positions uniquely rather than looking at it going, oh no, I'm red, and oh no, never mind, that's just a wheel position I have open. So for me, having that kind of psychological break of I open up my Webull account and that's wheeling, or I open up my TD Ameritrade account that's wheeling. But the core of it's going to be a ticker that you want to own long term. So in the weekend, the example I used over the weekend was ExxonMobil. It doesn't have to be ExxonMobil. You could say, I'm bearish on ExxonMobil. I don't want to own it. So we can choose something like we can do Tesla. I mean, Tesla's probably going to be an interesting one to look at in terms of wheeling. And I have no levels on here, and we aren't really looking for ultra specific supports and resistances uh, for wheeling. We're looking more at like supply and demand zones. And the reason I say that is because we're really looking for essentially a trigger going into the first part of this options wheel, which is going to be selling the put. So for Tesla, and I mean, I certainly wouldn't mind owning Tesla. And that trigger for me is probably somewhere in this zone. We're talking 124 to 165 would probably be a reasonable price target. You might want to shift it down to maybe here. But you were kind of talking in this zone of. So we got the wheel over here, right? This is the options wheel I was referring to. And the top of it's going to be selling puts. So when you're looking at these tickers that you want to own long term, uh, using supply and demand zones is a little easier for me because it says that, hey, we are getting into this zone that's triggering. I might want to sell a put against this. And you can kind of use this as your target. So on the first leg of this wheel, and the hub of this wheel is going to be the ticker you want to own long term. So for this example, we can use Tesla. So you're going to go into your trading account and you're going to look at the Tesla options chain. So what you're going to look to do is sell anywheres from 30 to 90 days out, and it's kind of going to depend on the premiums and the liquidity you see on them. Something like Tesla is going to have plenty of liquidity available in their options chain. So we can look at something, let's say 45 to 60 days out, and I typically want to sell on an OPEX day. OPEX, being December 16, Jan 20, all these major expiration dates, not these weeklies. And that's generally you're going to see better liquidity on those options further out, and you're going to generally get better premiums. There's a lot of times where I've looked at things and I unintentionally looked at, let's say, like the December 9 or the December 23 versus the December 16, and I see that one, the liquidity is lacking, and two, the pricing is not that much different. So you can extend, the extra 7 days to December 23, and you see the pricing is no better for the time that you're paying. So if we look at 60 days out, in this case it's 59 days out, we're going to look at the Jan 20 OPEX date, and we're going to go back to Tesla saying, so where is a price that on this stock that I don't mind owning long term? Well, I probably don't mind owning Tesla at 125 a share. So we're going to look at 125. We're going to kind of keep, let's say, 165 in the back of our mind as well. So we're going to look, and we're going to have to expand this. Oh, and it's also just had that split. So their option chain is a little funny. So 125, you're going to get paid, and let's just call it probably 360 for that put. So you're going to receive $360 in exchange for setting aside $12,500, right? You're paying You're essentially setting aside the money, you're locking it up at $125 a share times 100 shares. So you're setting aside $12,500 a share. In the interim, you have received a $360 premium. We're going to call it halfway between these two. You've received $360 for a risk return of, what's that come out to be? Like 4%. So you get essentially a 4% ROI on that, just on premiums alone, right? So as we approach our expiration date, and this is going to be the part about kind of calming the storm. You gotta be able to weather the ups and the downs when you're selling options. I look at it in some days, or I look at it and it's red, implying that Tesla has gone down, and I could have in fact gotten a larger premium for it. But so long as we're not below 125 by expiration, despite how red it may look, you're still in the green. If it's 125.01 at expiration, you've collected that $360 premium for absolutely nothing, and then you get your $12,500 back. The ideal scenario in this, if you really wanted those shares, would be that Tesla expires or closes the trading day on January 20th at 124.99, meaning you've received your $360 premium. You have in fact paid your $125 a share, and you have bought those shares for $125 a share, but they're worth $124.99, meaning that you are $12,500 less $360, so you are $359 profit immediately. So that is the ideal scenario, right? Or the moment you sell the puts, the Tesla skyrockets, and you can buy those puts back for even less. So those are obviously the two ideal scenarios. So let's say that it comes to expiration and Tesla is now at 115, meaning that your aggregate cost, despite receiving that premium of 360, you're going to be red by, because your cost aggregate is going to be what, 121.40. So if you're at 121.40 and it's at 115, that means that you would be immediately stepping into a red position. So what you can do is you can take assignment saying, you know what, I think that we are still at a local enough bottom where I'm okay taking assignment at a slightly red position, knowing that you could go to the next part of this wheel. So if you are assigned, you can then sell calls and receive additional premiums. So if that were the case and it goes down to 115, you could, your cost aggregate being 121.40 for those 125s, you could in fact go and sell, and you got to kind of like mimic what the options chain would look like at the time. So you could say, okay, I've received those calls. I have received the shares rather, and I'm going to go ahead and sell calls against it. So you would just, again, you can mimic this in your head saying, if I receive something, what's an at the money call look like? It's 60 days out. Well, an at the money call would look something like, let's call it even $14 or $13 per share. So you can go ahead and sell something 60 days out for $14 a share, meaning that you're reducing your cost basis from 121.40, $14 down, so you're at whatever it is, 108. So all of a sudden, you've dramatically reduced your cost basis in a very quick and rapid fashion. However, what we have seen recently is that you can sell essentially a diagonal against your puts, your cash secured puts, I'm going the wrong way. So in the case of last Friday, we had an OPEX date, and I had some BOIL shares, so BOIL cash secured put. It was a cold. My apologies. It was cold. I was able to go and say, I'm going to show you this specific example. And we're going to look at their options chain here. So essentially what happened is I sold an 18 put for, no, maybe it was it was a different account. That's okay. So I sold an 18 put for like $200, right? So $2 a share. It came up to expiration, and I was able to roll it back to a 16. So I basically bought it back for a loss of $200 on that put. I was then able to sell a 16 for $475, meaning that despite me being red on that put, I was able to sell an even further put down for more than the cost it took me to get out of that put. So it was that I had to buy it back for $400. I sold it for $200, net loss of $200. I then sold it for, I believe, $475 or $375. Essentially, I had received an additional $100 on that call position, and I was able to reduce my cost basis down to 16. So there's a lot of times, and this is one of those, it's good to know in the back of your mind when you intend on wheeling and you intend on rolling these things out, looking at the options chain a couple days beforehand or a week or two beforehand when you're coming up to your expirations. It's good to look at it and say, okay, this is where I need to be. I can go ahead and make this maneuver, essentially creating your own custom diagonal, right? Because you had already sold the put and now you're going to buy, or you already sold the put, so you're going to buy it back and sell another kind of on your own rather than one swift motion there. But you can do that, and especially in this economic environment where puts sell for much more than calls. You know, the antithesis, you're getting much more out of the put side of things than you are the call side. So puts are a little more juice right now, and you're able to collect more premium by reducing your cost basis some of the time. And in this case, that's a lot of the time you're able to do that. We saw another example with Sadie Den, who had Airbnb, where he had sold a 100 put, and at the time, Airbnb was at 99 or 98 or something like that. So he was kind of thinking free money. So I think he had received $100 for that put. Well, the put came up to expiration, and they were at 95. He went and sold another 100 put for $600 or something like that. So he had kept the same strike, but he had received an additional $400 for keeping that same, just for extending his position. And that's the idea of kicking the can down the road, continuously reducing your exposure and continuously reducing your cost basis on this, where eventually you can just keep on kicking the can either at or below your original strike until you're right, where it will either expire above your strike and thus you collect the entire premium, or it will expire right below your strike within pennies or within what you consider to be an acceptable cost, and you can take assignment. So continuing on to the next part of the wheel, you can, like I said, so on the selling puts, you can keep on kicking the can if you're not right yet. You can keep on kicking the can until you are right, or if you're within what you consider to be an acceptable cost basis, and again, the ideal cost basis would be, let's say I sell at 96 and they expire at 95.99, then I'm guaranteeing my right to buy these shares at 96, and I'm immediately green considering I have taken in this premium. So the next part is when and if you decide to take assignment of those shares, you can go ahead and sell calls against them. So this comes back to there's a couple different ways to sell calls against things. The two most commonly accepted practices, again, selling on OPEX days generally, and you're looking for anywhere from 30 to 60 days out. And we'll revisit that in a second. But if you want to sell 30 to 60 days out, generally the two most commonly accepted practices are selling either a 30 or a 16 delta call. Meaning, if those are unactive, those are passively managed positions. If you were to sell a 16 or a 30 delta, then they are the least likely to be exercised with the most theoretical profit. And after all the backtesting that's been done, that's pretty well proven. Obviously, if you're selling 16 deltas, you're less likely to be assigned than you are the 30 deltas, but the 30 deltas generally, always will pay more than the 16 delta. So when you're looking at something like Airbnb, you can also kind of theorize what your wheel position is going to look like, not only based off of you've gone through, let's say, 1 or 2 or 6 cycles on selling puts, but you're also going into the selling calls portion if and when you decide to take assignment of those shares. You can go ahead and look at it and say, if I'm selling at the money calls, or let's say you take assignment at 105, you're looking at it going, you know what, I'm going to take assignment of these. I just got to kind of theorize when I take assignment of these, what does something that's $10 out of the money look like? Well, you can look at something that's $10 out of the money and say, okay, well, that's a 24 delta. So it's somewhere below the 30 and above the 16. But if I'm selling $10 out of the money on a $100 shock, I'm able to get, let's say $160 in premiums off of this. So you know how quickly you can reduce your cost basis. But if you would like to go even further out, because again, some people like, and this is going to pair into your charting. If we look at the Airbnb chart, we can say, okay, I know that there's, good resistance at, let's say, 110 or 111. So I'm going to sell 112 calls, set it and forget it. Well, okay, 112 calls aren't available, but 115s are. So if I go 60 days out, I can say, all right, well, I'm going to sell those 115s for $180. And thus you've reduced your cost basis even further by $180 for each option you take. And you can keep on doing this end and keep on kicking the can over and over and over again, where the math will always favor you in that if you sell, let's say you sell a $100 call, and it comes up, and the most ideal scenario is going to be it expires at anything less than 100. But ideal to me, if I'm selling $100 calls, is Airbnb comes up to this expiration at $99.99, meaning I collected the premium, my equity position has not decayed, and I've collected a $600 premium for that. I sold somebody to the right to buy these shares and it never got exercised. And most of the times when I'm selling calls and if I'm not paying attention to it, I think there's only been once where I didn't get exercised. And that being said, I believe there was once where I was exercised early. I think there was one time where that happened, but if it has, it was quite some time ago. But it can happen. But that being said, if you get to this point where, let's say you sold again, we're gonna have to kind of pretend here, right? Let's say I sold a 90 and it came up to expiration and it's worth, $11.20. So the stock at expiration would be trading. And that's the other thing to keep in mind. I guess I'm going to have to revisit my statement. Coming back, the most ideal would really be anything less than 100. Okay, so if it's less than 100, and if you sold this call for $100, if it expires at expiration at $105.99, you could theoretically close that green. So if you were to come to this expiration and it's at, let's say, $110, and you said, I don't really want my shares I don't want my shares called away, then you can go ahead and you can kick that can and you can sell further out. And the math, believe it or not, is always going to favor the seller in this. And that you can buy it back, let's say you're going to have to pay $11.20 to buy that back. Well, you can go ahead and sell the next 90 for $13.70. So even had you buy it back at a loss, you're able to sell it for a profit. So you've reduced your exposure even further by doing that. So you can keep on kicking the can, and you can go, if you really wanted, you can go further out and say, you know what, I want to keep that. I want to keep that. I don't want to reduce my cost base. I don't want to keep that. I want to buy it back for $900. I want to be able to sell something where I still can get $900, and you're going to have to go further out. But you can find that where, okay, now we can sell 105 for $975 rather than a 90. So you can, again, continue to reduce, and you're essentially building your own stop losses by doing this. Where you say, okay, well, what's my exposure going to be? Okay, it's going to be 105 minus the 975. So you can keep on inching it upwards, and you can keep on kicking that can down the road. And a lot of this is going to play into what's your fundamental analysis, what's your due diligence tell you, and what does your chart tell you? And then it's a process of lather, rinse, repeat, where if your stock does get called away, you've freed up even more cash. If you're playing this the calm way and you're not panicking and rushing into, okay, you know what? I sold it and I immediately went green. And that's the tough part of this, right? Is let's say, and here's one thing I forgot to mention, I believe I forgot to mention this last time too, is you want to sell calls on green days and you want to sell puts on red days, right? Because you're getting the differential there, or the closer you are to your strike, you're going to get more on the put side and less on the call side. So as it goes up, those calls are going to be worth more and more. So you're going to want to try to capture that the best you can, again, by relying on your chart and by relying on your fundamentals. So the trouble, because we're looking at anywhere from 30 to 60 days when selling these options. And you've got to remember that these are theta strategies. Time, unlike being a buyer of options, as a seller of options, time is your biggest ally. So it's so difficult. It's a mindset change when you go into selling options, because you get into this. We're not necessarily trying to time it perfectly at the bottom. If I'm looking at selling Airbnb puts, yeah, it would be ideal to be able to sell it at this 87.10 right down here. But probability says that if I'm really considering this Airbnb put, selling this put, I probably would have taken it somewhere around here. I would have been thinking about it here. It's coming further and further down. I saw 3 brutal red days and I said, here's my opportunity. And if we zoom in, what would have happened to that put? Let's say we sold a 60-day put. If we sold it on June 14th, we would have been red or green the next day, and we would have been immediately red. It would have hung out red. So if we had sold on this day, let's say we sold a $95 put, we would have been green, and then we would have stayed red for almost 2 weeks, almost a month, really, until we get to this knowing that, one, time will decay it, and two, we're okay. Even if you end up after, let's say everything goes against you, your fundamentals are right, your technicals are right, and you just didn't get it right, and it went red for the entire time you held it, or it went red right at the brutal end. You know that you can always go back, stay calm, and extend your position. You can sell, you can buy that one back and sell another one further out. And the way that money works is we know that implied value is always going to be there, even if it's only a penny. When you buy it back, you're going to get more than that penny back because that implied value is there. And that's going to be on the put or the call side. So you're the master of your own destiny, unlike when buying options where you're at the whims, really, of the market. So you're master of your own destiny in this, and you can pick some of the worst positions and still manage your way into a green ending. And on that, I'm going to take a pause, get a drink of water. And you guys have any questions so far?
No, not really. Most of the same stuff we covered before and stuff. Obviously, market kind of getting towards the top of the trend, yearly trend, right? So we actually have a massive beat today. I actually was thinking about selling some calls today. Did you do anything?
Yeah, so that's what I was talking about this morning. Was I took today as an opportunity to manage some of my wheels.
Yeah.
Especially when we had the turnaround around 10 o'clock. I said, this is a good opportunity for me to kind of tweak some of my wheels. And I've got wheels spread across a couple accounts here. So, again, knowing that I probably did not get a perfect timing on probably any of my wheels, it doesn't really matter.
Yeah.
Because, one, I opted for 30 deltas, and I actually sold some for this week, which is a little uncommon, but I'm being a little more active in selling some of those positions. Oh, sorry, not the ticker I meant to click on there. So I have some T triple Q calls, T triple Q shares, and I sold somewhere around here. I was able to manage some of them right around here. And anytime we take some of these massive dumps, it's a great opportunity for me to just say, okay, it's time to look at some of those equity positions I have. So I bought back some of those calls, and I sold some more around here, and they immediately went red, which is okay. Which in the end is okay, because one, fundamentally, I still believe we have more to go. But two, I know that at the end of the day, if I go to, let's say, a T triple Q position, and I go, you know what, I sold some 25s. Yeah, we can just take a look at that position here. So I sold some 25s. If I go and take a look at that 25, it was right below. And that was the other thing I forgot to mention. If you're ever considering selling strictly this 30 delta or the 16 delta, you're split between, okay, I don't have a 30, I have a 29, I have a 33. Opting for the 29, you're going to go, this is like Price is Right rules. You want to go for the sub 16 or the sub 30. So I sold some 25s, and I didn't get 70 cents of it. I got like 60 cents. So I'm immediately red. Well, that's okay. That's not going to change how I feel long term. And if we do get into this immediately bullish position, I can go ahead and I can buy that back come expiration, because really what I'm looking for is anything less than 25.69. That's, that would be my, okay, now I'm actually going to be red on this position come expiration. But let's say we're at 25.71 or above. Well, do I want them to get called away? No, I don't want them to get called away. So I can go ahead and I can sell a 25 the next time, or I can sell a 35 for a month out, where I can say, okay, you know what? I'm going to have to buy that back for a 1 penny loss, and I'm going to reduce my cost basis by 47 cents minus 1 cent. So I'm reducing my cost basis by $46 per wheel. And it really is this selling options is about keeping your calm. You don't have to be in a panicked position because you control your own fate. And then there's multiple spin-offs of wheeling. So again, I started this off with the hub of your wheel should be a stock that you want to own long term. And I think we can generally agree that these stocks that we want to own long term are going to be somewhere like a blue chip stock. It may or may not be a FANG Plus stock. It may not be one of these big eight. It may be Snowflake or ExxonMobil or Shell or COP. I mean, we can go down the list. It could be Enphase, but they should be one of these companies that you believe in fundamentally long term. I think generally speaking, you're going to want something with better liquidity. So even if it's Home Depot, you really believe in Home Depot long term. Home Depot has adequate liquidity in order to wheel. Costco has adequate liquidity. GM, all these companies are going to have. And so when we're kind of talking about this, the core theme here is they're going to all have a market cap of probably in excess of 20 billion, and they probably all have a historic, a history of strong performance across multiple market conditions. And the other thing that people love to do is they love to sell options on dividend stocks. And I think that's probably going to be another kind of core theme here, is that you're going to have your dividend stocks that are generally going to perform well over time, and they also make for good wheel candidates. So with this wheel as your hub, and I've written about this, I've talked about it before. Let's say you have, and I'm going to throw a number out there, and I think people may disagree with that. For me, I keep about 85%, and that obviously fluctuates from week to week or day to day, but about 85% of my portfolio is wrapped up in wheels. Wheels that I can keep on kicking the can on, or I can finally let them exercise, such that I can free up more cash. So from this wheel, let's say we start with an original account of $100, and I'm selling options on that, and I'm just continuously collecting premiums. And from that $100, I've now generated an additional $100. So I can take $25 away, or I can take $40 away from that. And I can say, okay, now I've used these, I've got more free money in my wheel account, and I can take some of that free money out where I can use it in a binary options trading account. Or you can start a different wheel over here on something cheaper. So you can say, what we've kind of talked about is something, this concept of a hot wheel, right? And there's different flavors of hot wheels. We have different degrees of spiciness, right? Something spicy might be something like a GameStop hot wheel, where there was a time when I had a lot of luck selling puts on GameStop, and once upon a time it was a very juicy options chain to sell, especially because you could watch it. You used to watch it regularly dip below 95. You sold puts, and it would rocket right back above. It's calmed down a little since. I've done it on AMC a few times, so that's one degree of spiciness, right? You've got that that's a Hot Wheel. Another flavor of a Hot Wheel, and I think it might in fact be a higher degree of exposure. It might be a little more spicy. Is to take something like, let's say I've got IBM. I don't know. I've got IBM, and I really don't believe in their short-term performance. I can go ahead and I can sell in the money puts, and if we look at or in the money calls rather, and if we look at something like IBM, and we look at their options chain, and we say, I don't believe in their performance in the next 30 days, obviously selling an in the money call is going to yield you a greater premium. So you've got your target and you're looking at it saying, we're at 137. I really think we're going to come down to the 120s. So if you sold, and you're not going to want to sell something really deep down there unless you really want your shares to exercise, because selling in the money calls is a great way to ensure not only a premium up front, but for your shares to get called away. But remember, if you're going to sell, in this case, it's going to be like a 140 call, you're going to lose those shares at $140 a share. You don't get them if they go, you don't get the delta if they go up. But let's say you really don't believe in their performance long term, or you really want to actively manage that position, you can sell in the money calls. Let's say it's at 149.50. I'm going to sell 140 calls, really believing that my technicals and my fundamentals lead me to believe that they're going to go to 135. So you can pick somewhere like an intermediate point there. You say, you know what? If they're at 138, I think they're going to go down to 115. I'm going to pick something like a 125. And you pick that in the options chain, and you're going to go in that way. That way, if you're not going to overshoot the bottom, because again, wheeling's not really about perfectly capturing the top or the bottom. It's about capturing the idea. And I think where everybody present is very capable at capturing the idea and not necessarily always the timing. I think that's been a pretty common theme recently, is that my timing, my theory has been good, my timing has been bad. So knowing this idea, and that I'm giving myself a band and 60 days in time to decay these options for me, I can say we're at 137. I think we're going to go to 115. Let's make sure I don't overshoot it. And I'm going to sell a 126. And you go over here and you sell that 126 and you collect what's going to be a really healthy premium for that. And that way, when they continue to slide past that point, you can buy those calls back for really cheap. So I think that's the other degree of spiciness you can get from hot wheeling.
Yeah, well, I do that a lot of times when, based on fundamentals sometimes. Like Intel, I've been selling, I was selling at the money, and I started selling at the money after their 2 ERs ago when they missed badly and they lowered guidance. That's when I started selling in the money calls. I just said, well, they basically said they're going to be crap until this goes on.
Right. And again, what the worst that can happen to you, knowing that there's always going to be that intrinsic value, is you were wrong. And then you buy them back and sell them for more money. You're just extending your timeline. That's the only thing you're ever doing with these strategies, is if you get it wrong, you extend your timeline. If you remain calm, the worst you can do is just lock up that money for a little bit longer. That's the worst you can do.
Another aspect of hot wheeling that I sometimes do is I sometimes will sell options before earnings reports.
Yep.
When the IV is super, super high.
And that's something that you and I have done, like with Netflix just recently prior to earnings, was we sold deep in the money puts. So even if we were wrong, and if you really wanted to do that, you could collar that. But you can sell these deep in the money puts as IV gets jacked up right before earnings, where you're guaranteeing, or you're doing your best to guarantee free money or very low risk money. And something like Intel being cheaper, it might not be that attractive on a singular scale. But if you jump into something like, let's say, I think Snow has earnings coming up soon.
Yeah, that's kind of memey. Some of the meme ones like UPST will get to like 300% IV. And it's pretty crazy.
Yeah. Oh yeah, UPST. And so we know from trading binary options where these chains get pretty jacked up and they get pretty juicy. So on December 2nd, when do we have those earnings? Those earnings are 11:30. Okay, so on this week. So maybe sometime next week we could look at selling a deeper in the money put on Snow. And they like a 128, if they stay flat here, 128 might be somewhere around, let's say, $6 or $7. And that's a very low risk compared to reward. Especially if you believe fundamentally in their in the company. So this would be actually a good one to visit sometime next week.
Actually, this is another one that might be good to visit. I think is CRWD. They have an earnings report 11/29. So I can see the December 2nd strike is already getting a little jacked up. It's already at 85%.
Yep. Yeah. And I'd probably have to. Oh, I have IB pulled off from this right now, I think.
Yeah, you can tell because this week is only 44% IB, but next week is 85% IB. So people are going to start loading up in this one. And this one could hit 2%. So if you own shares or whatever, or if you wanted to own shares, that you could theoretically you could sell an option right before the when the IB is highest. That's when people will be paying the most for these prices.
Yeah.
And a lot of times, if I wanted to acquire shares, I didn't mind. I said I want to acquire shares like now or whatever. I would sometimes sell that weekly one and just get that huge premium. I was like, well, if I get filled, then I get the shares, and then. But of course, there's a little. That's part of Hot Wheeling is that, of course, if ER is terrible, then you might get filled at a really bad price. But again, that's part of selling options. Is like when you sold the put, you're like, well, I'm finding assigned at this price, right? So you guys get
right, and that's when you go back to what's the core of all this wheeling, is that the core is going to be, it's a stock that you want to own, and you're selling it at a strike that you're comfortable owning it at. When you get these offshoots of like Hot Wheels, like my Snow position is admittedly a little bit of a Hot Wheel because it's a super juicy options chain. And I'm looking at Snow going, okay, now I sold somewhere over here, and I bought back one of the legs at a modest gain, and then I've just continued to watch this last one ride out, and it's for January. So my assignment prices, I sold a 155. I received just over $2,000 for that. So my assignment price is fairly low, but right now we're still at a point where I'm not seeing enough decay to watch it just dramatically drop as we come. Even if we went flat here, I wouldn't see that decay until probably mid-December. And you can look at those decay curves. I think decay really starts around 60 days, and then it's obviously logarithmic, so it comes down dramatically towards the very end.
Yeah, you know what? CrowdStrike is what, cybersecurity?
Yes.
And PanW is almost cybersecurity, right?
Yep. Interesting. That's a good point. That CrowdStrike and PanW have, although PanW had some very high praise during their earnings.
Yeah. So I'm wondering, if you wanted to own CrowdStrike, which I think like Mark does, wherever, you can sell a put right before you are at a price you're comfortable with. The price you should get a nice premium.
Because you're right. We are seeing IV at 86% already, and I think some of these, like the UPST earnings we saw, that was boy, that was like 260%, I think, 250.
Yeah, they get really high. The mean ones can go like, I've seen one goes to like 500% sometimes.
And I think we even saw Netflix at like 180%.
So here's what I struggle with. So say theoretically I did want to own CrowdStrike share, right? So I want to sell a put. Would I want to sell these now when there's still time and the value is high, or would I want to be like, would I want to sell it right before ER when the IV is highest? Because these are 12.2s, so these should start losing value as it gets closer.
Right. I mean, they start losing value obviously from inception.
Yeah. The only thing is that it's a Tuesday ER, so that's still plenty of time after that.
Plenty of time throughout the week.
So if I wanted to own CrowdStrike, I may just wait until right before the ER and then sell it that day. And that would be its highest.
Yep.
And again, it goes to the chart, what price would I want to put this out?
Yep, and that's going to return back to, again, fundamentals and technicals. Where do we think a good value is on Crowd? And I don't know that much about CrowdStrike, but if I were to say, what are the levels I would want to own CrowdStrike, it's probably somewhere in this ballpark.
Yeah, I was going to say it's actually pretty decently close.
As a matter of fact, we probably could have, if we were monitoring CrowdStrike actively, we probably would have begun to trigger that, hey, start thinking about buying me or start thinking about selling into me. And that's one of those things that when I started getting into wheeling, things like buying lots of shares became much less attractive because I can continually adjust my position until I was red, until I was green.
Maybe put an alert at that bottom again, at that double bottom.
Yeah, and that would be, I mean, we're talking about a massive double bottom here. Boom, boom.
If we get one more, then theoretically we can sell a put right around 120 and hope that it bounces hard. And it actually may, with Thanksgiving and everything, it actually may touch 120 before earnings. You look at that, it may actually do a little.
Yeah, we very well could return back to this like 119 area.
And maybe earnings will help it bounce.
Yep.
If we assume that they're gonna have a good earnings score like Pandemic did.
So these are, like I said, these are the kind of fundamentals that we look for when entering these wheels.
And you can also draw a trend line, right? And that's the downward trend line, and then just sell it when it breaks it, I guess.
I wonder if you can capture this whole thing. Not quite. Can't quite capture that whole thing, but you can definitely capture it here.
But even more, just a more recent one. Theoretically, you could be like, well, maybe I'll sell it when it breaks that. Sell it when it breaks that.
So we're looking somewhere in this ballpark. And that might be more of a channel than a trend line. But yeah, so these are the things that you should be looking for. You should start the core of your wheeling account, of your wheeling positions, by targeting stocks that you want to own long term. And then you can kind of go off on these alleys. You take your wheels down different alleys, right? And explore some of these other hot wheels or these little more aggressive, little more juiced wheels, because you're going to find that something like AT&T or Southern Company, these blue chips that have been around forever, they are less likely to have a juiced options premium. And that's for a good reason. They're much more predictable. They're much easier to sell against. Coca-Cola. And you think about something like Warren Buffett Holdings. Those are all positions that he's selling options against. Warren Buffett is not just buying these shares and holding them. He has people and teams dedicated to, okay, well, we're going to wheel our Coca-Cola shares. He's collecting premiums on that position. And I think Mark said it maybe once or twice today and maybe once or twice yesterday. You want to sometimes think about having the mindset of, do I want to own these shares for 10 years? Because if I don't want to own them for 10 years, I probably don't want to own them for 10 minutes. And that's an especially good mindset to apply not to a scalper, but that is a good mindset to apply to somebody who wants to wheel. Because at the end of the day, or at the end of the month, or at the end of the year, you can wheel these positions down to zero, near zero, or sub-zero cost basis. Where you can get to, and I was talking to Yerf about this today, where why did I take this cold position? Well, I forgot that I had taken it because I had free Boyle shares. I had taken it because my Boyle wheel had paid me so much that I was able to open up a position on the inverse on cold for zero cost to me. If I were to take assignment of those shares, it wouldn't have been any of my own money. It would have been all courtesy of Boyle. And that's going back to, I guess, what I started with originally. It helps me keep track of this stuff by keeping it in different accounts. Having multiple accounts where I can watch this and say, okay, this is my wheeling account, or this is just my natural gas wheeling account, where I can look at it and, okay, this is my position here. And we're doing well. And I know how much I started off with there, and I keep active track of, what my true cost basis is. Does anybody have any questions? Comments, concerns?
No.
Ruben, Jen, Carrie, Savvy, Mark?
Nah, really good.
Appreciate you re-going through this thing. You asked some really good questions. I appreciate that.
Yeah, I appreciate you guys listening to me yet again. And I apologize for not recording it the first time, but I definitely recorded it this time, watching it. So no heartbreaks at the end of this one. But yeah, if you guys don't have any questions or you have questions later on the road, feel free to DM me with ideas or anything like that. And I appreciate it. Appreciate your time tonight.
Yeah, good stuff, man.
All right, have a good one.
Appreciate it.
Bye.